This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. We don't often go in for themes at Street Signals HQ, but seeing as it's Lunar New Year this week, and as one of my colleagues has just returned from a long visit to China, it seemed fitting timing. Ning Sun, a senior emerging market strategist based in our Boston office, is just back from 2 weeks of meetings with clients, policymakers, municipal governments, multilateral institutions, and rating agencies across China. And with so many challenges, from a domestic consumer that continues to struggle, to an export boom amidst what, in theory, are greater protectionist sentiments in the West, I'm keen to hear what she learned and how she thinks the year of the fire horse will end up for China. Hello, how's it going?
Good.
Gung Hei Fat Choi, is that what we say here?
So what? Everybody talks about that in Cantonese. That's
Okay.
Gong Hei Fa Choi. That's Cantonese. Yeah. The Mandarin part is similar, actually. Yeah.
Okay.
But I can tell the difference. Those are 100% right.
Fantastic. Well, I'm not even going to profess to be anything other than naive when it comes to this. So
Oh,
as noted in the introduction, you've spent a couple of weeks in China seeing all sorts of people. We'll talk about that and who you met with, not specifically who you met with, but the type of people you met with. But first and most important question, can you tell me what is significant and what we should expect for the year of the horse, and particularly the year of the fire horse?
oh, wow. Okay, Tim. So
Yeah.
Year of the Horse, and it's actually associated with energy and strength. And to double it up with fire, that's, I think, double the energy and the strength. But the problem is that energy and strength are all good, right? But you need to have the right direction. If you're
Yeah.
heading towards the wrong direction, then more energy is actually not that of a good thing. So this year, unfortunately, the horse year cannot tell you that, but it can only tell you you were going to have a lot of volatility, a lot of strength. So I think, in my opinion, that Tim is the in-house expert on options. Option price is still low, right? We should more, listen to Tim, talk to him more for the rest of the year to where we're heading over.
That is a fantastic answer, Ning. I think we're just going to leave it there. We will be doing a lot on options this year. I'm sure
Okay.
people will hear more about that. But that is a good thing to hear. Strength and energy are two things that this time of year, especially if you live in the UK where it's been raining pretty much every day, none of us have too much of. But let's talk about the trip. I mean, it was fascinating to see just the wide variety of clients and officials you met with. So could you give for the listeners, give a brief wrap up of the types of clients and other officials that you saw over the last couple of weeks?
Sure. So I joined a group of investors from pretty much all over the world, Asia, Europe, and America. And they're all interested in the China story. Of course, I met with our clients in China as well. Those are large institutional clients. So we met with government officials like the central bank and also a couple of the municipal governments as well. And on top of that, we also interacted with the local commercial banks and also like rating agency, even U.S. Chamber of Commerce, multilateral lenders, and that sort of the entities. So it's a very eventful trip. I learned a lot, certainly, from those.
Yeah. And I wanted to start with the growth outlook for this year. And of course, China has had its share of growth struggles, whether it was a few years ago related to the property market, but of course, the pandemic and the recovery from that being sluggish, especially on the consumer side. And yet we still have growth targets that are around, say 4.5%, maybe 5% growth that have been met by exports, which we're going to talk a lot more about. Would you say there is optimism around the growth outlook for China, or is there still some retained skepticism of meeting future growth targets?
No, Tim, China is a large country. It's hard to really get the whole picture, but I tried. And the takeaway I got at is everything you said just now, they're true.
Yeah.
Meaning that all of those things are taking place at the same time. I feel that there's right now a strong phenomenon of a two-speed economy. So one is the certain area, China is the top-down economy. It's a command economy. And then wherever the government focus their resources on, this 10P the sector to be successful in the future and even currently. So those are the sectors I would point out, like the new tech industry, the green energy, EVs, AIs, robots. Yeah, I think that's better reflected in the equity market valuation. And meanwhile, the rest of the more traditional sector, you mentioned it, the property sector, even of the low-end manufacturing, they are struggling. So both of them are taking place at the same time. Depends on who you talk to, actually. Even though, let's say, people worried about the employment condition in China, it also depends on who you talk to. If you talk to, let's say, the young people who actually graduated with the AI-related credentials, they are making good money, not hard to find a job. But if you are, unfortunately, in some other traditional sector, that's a completely different story.
Yeah. I mean, what does that say? We've talked for years about the need to reorient growth towards the consumer. And again,
Right.
we'll come to the trade side. We'll come back to this in just a minute. But I wanted to ask about that because it is a two-speed economy, as you say. There are graduates who have great opportunities, but the consumer is still not kind of driving the car at this
Yeah.
point. The engine is exports. The engine, as you say, is investment spending. What is the progress on that then? And what should we expect it to be if it is running at this kind of two-speed economy?
Yeah, that's my question going into the country. So coming out of it, I thought, I'm thinking that I get a sense of what is happening. If you listen to the government, they always talk about they want to transition from this investment-driven to consumer-driven. And to be honest, they're doing something to help
Mm,
support the consumer. They have the rebates to support consumer. They're giving out money for household having new babies. Those are all right thing to do. But I would think that those efforts are sort of on the margin.
mm,
This is not a huge like fiscal or monetary push to reorient the economy from investment, export to consumption. Actually, in my opinion, I think the export sector reflects the weak consumer sector because imports are declining. They have this overcapacity. They have to export overseas, right? But what I feel, what is going on right now, is not necessarily to be transforming from investment to consumer. I feel like it's more of a change or transformation within investment. So the investment coming out of the traditional sector to the new, faster growing tech heavy sector.
yeah.
Yeah, of course, they're still doing the infrastructure investment, but this is likely to provide a floor to the GDP growth, to provide some jobs. And then they are saying that even the infrastructure build-ups are more towards the data center, all of that new tech area. So I frankly don't see a very fast transition from investment to consumer in the next couple of years.
Yeah, my next question was how sustainable that is. And I'm especially thinking about what we've all had to go through the last year or two. The notion that the US, as well as Europe, I think now is no longer as willing to accommodate an export boom from China as it might have been in years past. And in as much as there's new technology that China is embracing in terms of its exports and trying to build market share there, how sustainable is it geopolitically, I guess, where you do have
Yeah.
more and more economies potentially pushing back on that?
Oh my God, you have all the good questions. I think the worry is definitely there,
Yeah.
right? Because China is not a small economy that can be easily absorbed by the other economies. For the next couple of years, there's still room.
Yeah.
For example, I'm seeing active push from China to export to the rest of to emerging market actually. And the emerging market, I think, lots of them, I think their economic model is more complementary to the Chinese one. If they're more commodity based, maybe they need the manufacturing goods still. And then the China is actually transferring technology these days to emerging markets and to some DM countries like German car industry. The China EV industry is transferring technology to them. And then on top of that, you see that we saw the massive trade surplus recorded last year, $1.2 trillion. And the central bank, when we talk to them, we're using that as an argument to ask them if they want to appreciate it more. They always pointed out to, look, we are big providers of capital to the rest of the world now. We're investing actively, not only in financial market, but in foreign direct investments, in emerging market as well. I feel this EM investing in EM is a new theme and has a tailwind is quite strong.
Do you think they see that as being, or do you know if that's end user demand in emerging markets, or is it simply a rerouting of the trade that was previously going directly to developed markets, but now has to kind of go in a roundabout way to developed markets?
I think both are happening.
Okay.
Both are happening. But talking to, because I cover Latin America as well. When
Yeah.
I talk to the LATAM, investors and consumers, they view the Chinese imports as a positive thing that can actually help them to improve the living standard. Look, who doesn't like cheaper and higher quality goods, right?
And thinking about the infrastructure side, but as well as the past levers of growth that China used to meet its growth targets, and I'm thinking here in particular about property.
Right.
Does the property market still represent a drag, or have we moved past that now?
I don't think we moved past that yet.
Okay.
I think at the peak of the property sector, if you talk about the overall, sector is supported by the credit cycle, which targeted at property sector, that's around 30% of GDP. That's really, really high. So after several years of property sector decline, that has come down to around 20, low 20-ish. So it's a fast decline. So you can see that. But based on just the official data, the housing price decline is still happening.
Yeah.
But the pace of the decline has slowed down.
And is it still the wealth effects or negative wealth effects from that is really holding back the consumer, or is it more the lack of support that you mentioned on the monetary and fiscal side?
Both, because in the one way you have that negative effect, another way that they don't really see a lot of support from the government. So people are saving. You look at the China saving rate; it's going higher and higher. Even the survey did by the central bank itself, they ask you, do you want to save more? Do you want to spend more in the next 6 months? The save more cohort has been moving up, and at the other hand, spend more has been shifting down consistently. I was in a couple of shopping malls in Beijing and Shanghai. The one with long lines in front of them, I took a look. They're like gold stores in both cities. Yeah, young couples are lining up. Used to be Louis Vuitton bag stores that have long lines. Now you don't see Louis Vuitton, like Chanel long lines anymore, replaced by the gold stores. Yeah.
Fascinating. Certainly explains why the gold price has been doing what it's doing, I suspect. Interesting. Well, you talked about the central bank survey, and that's kind of where I wanted to head next, was to talk about monetary policy, talk about rates, talk about currency policy as well. But as a starting point, I mean, we've talked about the drivers of growth and what's working, what's not working. Can you give us a little bit of color on what the inflationary process or the reflationary process looks like? And I'm thinking here both on the official data side, but also some of the messages we're maybe getting from the price stats data that we have from China.
Yeah.
What stands out to you right now?
So let's talk about our data, the price stats and the official data. So the official data started to show some improvement. But I want to point it out, our price stats data picked up the positive signal earlier, like a quarter earlier than the official data. So our data, if you look at the month-over-month inflation data, it started to bounce back into positive territory at the end. I think at the end of July last year. Meanwhile, official data remained much lower than that. Our data ever since then remained in the positive territory, and now we're seeing the official data has improved. So the latest one is 0.2% year-over-year number from the official data. Yeah, it's the Chinese New Year. Data is always quite volatile. I guess we need to wait until the end of February to see the complete impact for the new year. But I want to say that our price data continue to show better condition than the official data.
Okay. Does that then remove the need for future monetary policy easing? I mean, rates are already pretty low. Are the concerns, do you get the sense that the concerns about low inflation or even deflation are going away?
This is one of the biggest surprise from my trip. we were in the central bank talking to them. I don't feel the urgency. But after talking to them, I think I agree with them. So they're saying that, look, liquidity is ample. There's not too much we can do. Our job is going to be complementary to the fiscal policy because this is much more structural than cyclical. I think that diagnosis is true. And second one is that the way the price getting set up in China is different from, let's say, US and UK. So a lot of prices are set actually by the government. It's not driven entirely by the market force. They pointed out the basic like utility, the price of water, price of electricity, that goes into pretty much every consumer goods. These are still artificially suppressed by the government to keep it low. So they're saying that they don't worry too much about the inflation number per se, saying that if they wanted to raise it, there's lots of ways they can do it. But there's obviously a lot of reasons they don't want to do it yet. It seems to be the central bank saying the deflation problem is very much concentrated in several pockets of the economy. I would assume that's the traditional parts of the economy. Meanwhile, they're seeing China is going through this transition period, and there's lots of liquidity in the economy already. The central bank just don't see the urgency to do much, and they're not too worried about the inflation problem.
What about thoughts that you had or conversations that you had about the renminbi itself? I'm curious to hear what sentiment was like, because we've had this period over the last few months where it actually has been strengthening against the
Yes.
dollar. The basket value, and look, huge export volumes and large trade surpluses would tell you the currency is empirically still quite cheap.
Yeah.
I'm wondering what the thought process is, whether it's from investors locally or the authorities you met with, about how that's managed going forward and whether we should continue to expect strength in the renminbi.
So the takeaway is that they are reluctant to entertain the thoughts of letting the currency going up, appreciate in a meaningful way in a short period of time. They admit that the pressure is on the appreciation side. So they agree with that. So they can let it appreciate. The focus, the pace, and the magnitude of that. I think if you look at China, it's different from other, for example, Taiwan. The Taiwanese export sector is very much concentrated in one sector, one kind of product. But when you look at China, it's very much the complete supply chain. China dominates that. So they have both the high-end, high-efficient products, highly profitable products. They also dominate the low-end, low profitability, labor-intensive ones. So as we just mentioned earlier, the property sector problem killed a lot of jobs, construction workers. The new economy is not necessarily labor intensive as the old one. So if you let appreciate too fast, they're going to impact the low end export sector. That's going to kill even more jobs. I think the concern is there as well. On the one hand, those highly profitable industries, appreciation is not really going to impact them by much. They're still going to be super competitive, efficient. Meanwhile, the low end is getting killed. I mean, especially on the jobs. So that's something the policymakers are concerned about. So they'd rather have something stable. They like stability. They like the year of horse, but they want stability. Yeah, this is something. Yeah.
So it's not a completely volatile, strong, energetic year. Maybe
Yes,
it's
yes, yes, yes.
well, the local asset markets are another point of interest for me. We've seen greater interest in broader Asia, but I think China as well has seen some paring back of the underweight that we've been capturing in institutional portfolios for a very, very long time. It's no longer closing as rapidly as it was maybe last year or the year before. But I was curious if you got any impressions, both on the foreign investor side into China, as well as the domestic investor, and whether they're just looking to keep their investing capital at home or move it abroad. I mean, to a certain degree, capital always has to balance against, current account surpluses. And so you will see net outflows. But I'm wondering if there is investor enthusiasm for local markets that has increased as the potential for recovery has also increased in recent years.
Yeah, these are just, you can see that from the official data, but based on anecdotal conversations I have with overseas and domestic investors in China, several takeaways. One is that the outlook, the expectation on CNY, on the currency, has completely switched from depreciation to appreciation. So that's one. So people wanted to have more exposure to CNY denominated products. That includes equity, I think. And secondly, I think what is happening overseas, especially in the US and Europe as well, it creates a lot of uncertainty. So not necessarily China has improved tremendously from, let's say, a year ago, but what has the investors worried over other parts of the world, the DM parts of the world, making them more at equal footing, I would say. So meaning that they wanted to diversify. They still want to diversify. Another one is that it looks like the expectation for the US-China relationship is heading towards sort of like a low-level stability. Yeah, so that should be good enough for investors for Chinese products, assets in the medium term.
I wanted to come back to that actually in a moment, but first I wanted to think actually not just about China, but the region more broadly, because they are, of course, not the only one to be running enormous trade surpluses.
Right.
And you mentioned Taiwan. The chip demand in and of itself is creating enormous surpluses, and it's quite one-dimensional. But Taiwan is also not the only economy running large export surpluses. Korea is seeing this, and we're seeing actually in our own flow and positioning data a rotation, not so much out of tech, but rotating from US tech towards Asia and Korea and Taiwan especially. But all three, Korea, China, Taiwan, have these empiric arguments for currency appreciation as well as strong investment cases given the impact and the role that technology plays in their export basket. Could you speak a little bit more broadly about the expectations you have for, say, dollar Asia broadly over the medium to long term? Are we correct in thinking these are just very cheap currencies that should all have revaluation pressures on them? Or is it a little bit more selective than that?
That's a good question. Those economies definitely are very successful in the tech sector. Investors have paid attention and then rewarded them with the evaluation, with the flows. But at the same time, you look at, let's say, CPI data. It's not a coincidence that inflation at all three countries are low. So that means that probably the success in the tech sector remains very concentrated within the tech sector. It's not enough to drag up the rest of the economy. But if we talk about currency, we're talking about the whole economy rather than just a sector, right? If you do equity, it could be sectorial, but it's the whole economy. So that means that the low carry associated with that reduces the attractiveness of those currency. And you look at the balance of payments. At the same time, those economies are big exporters of capital. Like President Trump in the US wanted the Korean government and the Taiwanese government, and Japanese government to do FDI, massive FDI in the US. That should be able to balance, or even more than enough to balance the current account, the trade account success. So that could be the reason that has suppressed the exchange rate.
And would you throw the yen in there as it looks cheap? It is very cheap, I think, on most fair value models. It is running large trade surpluses, but does it face the same sort of challenges, especially with inflation now starting to come off?
Number one, I'm not a Japan expert, but I would say there seems to be a lot of structural reform potential ongoing in that country. So if that can make the rest of the economy to catch up with the tech success, then maybe that's more meaningful for the currency, that can support the currency. But at least I see it in Taiwan and in Korea, in China, is very much concentrated. That helps support the equity story, but not necessarily the fixed income and the FX side.
Well, you alluded a moment ago to the China-US relationship, and I wanted to start to bring us home to the geopolitical side of things. And of course, anything can happen with, the US administration being what it is these days. But I sensed a note of optimism in your comment about the relationship reaching some point of stability. What was the impression you got on that from your conversations? Can you talk a little bit more about some of maybe the details that is maybe giving rise to some of this optimism?
I think the US government has already pretty clear telling the rest of the world how they see the world, what their action plans are. The actions they took already in Venezuela, the focus back from the rest of the world to prioritize the West Hemisphere, I think that's not necessarily a bad news for China, right? So they feel that this is time, if you step back to your region, then maybe that means I can have more wiggle room in my region, my zone. And it seems to be that the two presidents are going to schedule to meet in April. That also set some good signals.
I think this sounds all very optimistic, and let's hope even in the year of the horse that this is still a relationship that doesn't become volatile in what could be a potentially volatile year. These conversations between President Trump and Xi, what are your expectations for kind of the next steps that they'll work on and ideally work together on to ensure that this relationship is one of stability? And what gives you hope, and what are you looking for in that relationship?
The trade tension remains a very big subject. If, let's say, the U.S. and China, U.S. can walk back some of the tariffs on China. For example, the fentanyl-related tariff is 10%. I heard that the Chinese side has done a lot to satisfy the U.S. government. If they can acknowledge that or give the Chinese a list of things, specific targets they want to achieve, I think there's room for that to improve. But whether or not it's going to happen still depends on the top leadership's negotiation. But I do see there's room for improvement. There's lots of those.
Fantastic stuff. Nangeng, it's been great to catch up with you. Been very comprehensive, and as it should be for 2 weeks spent in China. We look forward to catching up with you on this, though, later in the year. Hopefully, as you say, the relationship between the U.S. and China won't be volatile, but maybe the rest of it will be, which is always good for us folks in FX. But thank you so much for taking your time this week to speak to us about your trip.
Thank you for inviting me. It's an honor.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. For informational purposes only. It is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.